This is not a speculative headline driven by social media excitement or hype. Silver prices crossed $120 because physical supply failed under demand. This move reflects structural stress inside global metals, markets ignored for decades previously. For years, silver trading depended on paper contracts, exceeding available metal inventories worldwide. Futures markets allowed pricing discovery without requiring actual delivery of refined silver bars. That system functioned only while participants trusted settlement promises instead of possession itself. Industrial demand has now shifted decisively toward immediate delivery and guaranteed sourcing security. Manufacturers cannot pause production lines because metal contracts fail during shortages or disputes. Solar panel expansion alone consumes massive quantities of high-purity silver annually. Worldwide, electric vehicle adoption increases silver usage across batteries, power systems, charging infrastructure components, defense electronics, medical devices, and semiconductor fabrication all require silver with no substitute. Unlike gold, silver is consumed permanently within industrial processes and rarely recovered economically. This consumption characteristic makes silver supply extremely sensitive to disruptions or delays globally. Primary silver mining contributes only a minority of annual production volumes worldwide. Today, most silver output depends on copper, zinc, and lead mining economics instead directly. When base metal investment slows, silver supply contracts silently without immediate price signals. Recent years saw underinvestment across mining due to low prices and regulation pressures. Supply chains appeared stable until physical withdrawals accelerated across global vault networks simultaneously. Exchange inventories declined steadily, while paper volume remained artificially high on screens everywhere. This divergence masked true scarcity from casual observers relying solely on spot pricing. The breaking point arrived when delivery requests exceeded logistical capacity and available stock. Large buyers were offered cash settlement instead of metal, triggering immediate confidence loss. Once delivery credibility disappears, futures markets cease functioning as price discovery mechanisms entirely. Price then shifts rapidly toward availability rather than contract valuations or forecasts. Models. Silver began repricing violently as institutions competed for remaining deliverable inventory globally overnight. This was not speculative retail enthusiasm, but forced procurement behavior under supply. Refiners reported longer lead times, higher premiums, and allocation limits for large orders. Transport, insurance, and storage costs rose alongside security concerns for high-value shipments. As supply tightened, intermediaries withdrew liquidity, increasing volatility and accelerating price discovery upward. Regulatory oversight offered little relief, because physical constraints cannot be legislated away quickly. Governments monitored developments cautiously, aware silver underpins critical infrastructure and strategic industries nationally. Strategic stockpiles, if they exist, are limited compared to ongoing consumption requirements annually. Recycling cannot respond rapidly because collection, processing, and refining require time and energy. Scrap flows increase only after prices remain elevated long enough to change behavior. Meanwhile, industrial demand remains inelastic due to contractual obligations and production schedules globally. This imbalance creates a classic supply squeeze, amplified by financial leverage, exposure worldwide. Banks holding short exposure faced rising margin requirements as prices surged uncontrollably upward. Risk managers reduced exposure, exacerbating upward moves and removing stabilizing liquidity sources abruptly. Spot pricing failed to represent real-world transactions increasingly conducted through private agreements. Premiums over spot widened dramatically, indicating structural dysfunction between paper and physical markets. Retail investors encountered shortages, delays and rationing even at elevated price levels everywhere. That response signaled supply exhaustion rather than speculative excess or irrational exuberance cycles. Historically, such divergences precede lasting repricing events across precious metals, markets universally recognized. The $120 level represents an adjustment toward physical reality emerging. It does not yet reflect full equilibrium under constrained production and consumption trends. Further adjustments depend on whether new supply can realistically enter markets quickly enough. Mining expansion requires years, capital permitting and stable price signals sustained over cycles. None of those conditions exist immediately under current market stress scenarios. Unfolding. Well, now. Therefore, the current price represents a transition phase rather than terminal valuation level. Market participants must distinguish between nominal price and functional availability when assessing risk. Supply shocks in consumable metals propagate faster than investor expectations adjust or narratives. Information lag leaves many reacting late after inventory access already disappears entirely locally. The early phase always benefits those monitoring flows, inventories, and delivery terms closely. Once headlines appear, conditions are already entrenched and difficult to reverse smoothly again. Current conditions indicate stress rather than resolution. Across upstream and downstream supply nodes, contractual trust erosion changes behavior permanently within commodity procurement frameworks and pricing models. Rebuilding confidence requires surplus inventory, not merely promises or policy statements issued publicly. That surplus does not exist within present global production capacity constraints today anywhere. As a result, volatility remains elevated even after initial repricing shock subsides temporarily. Participants expecting rapid normalization misunderstand the structural nature of current silver market conditions. Shortages driven by industrial necessity differ fundamentally from speculative bubbles driven by sentiment. This distinction explains why pullbacks remain shallow and quickly absorbed by end users. Physical buyers operate on timelines unrelated to trading desks or technical indicators entirely. Their priority is continuity of production, not price optimization during shortage events unfolding. That behavior sets a floor under prices, independent of the investor psychology cycles, narratives. Once floors rise, ceilings adjust upward through negotiation rather than trading speculation alone. This mechanism defines commodity repricing under constrained physical supply environments historically observed repeatedly. Silver now occupies that environment as inventories approach functional depletion thresholds worldwide rapidly. The question shifts from whether prices fall to how supply responses materialize later. Near-term resolution appears unlikely given existing mining pipelines and demand trajectories locked. Therefore, attention moves toward downstream consequences rather than upstream fixes, unavailable immediately anywhere. Those consequences extend into manufacturing costs, inflation, defense readiness, and energy transition timelines. Silver shortages ripple outward, affecting pricing stability beyond metals markets alone significantly today. This interconnectedness explains why policymakers observe closely without immediate intervention options available currently. Intervention cannot create metal where geology and investment cycles constrain output severely already. Market forces therefore remain primary adjustment mechanism, driving allocation under scarcity conditions globally. The first phase of that adjustment is now complete as prices reset higher. Subsequent phases involve behavioral shifts, capital redeployment, and strategic responses still developing unevenly. Understanding this sequence is essential before evaluating what comes next for silver markets. The moment marks an inflection point rather than an end point in this cycle. The second phase begins when markets realize shortages cannot be resolved through normal channels. At this stage, price discovery shifts entirely away from exchanges toward bilateral negotiations. Buyers stop asking what silver costs and start asking whether silver exists. This psychological transition changes procurement behavior across all silver-dependent industries globally. Long-term contracts are renegotiated under force majeure clauses, protecting production continuity. Suppliers introduce allocation systems favoring strategic partners over spot market participants. Smaller manufacturers face delays, cancellations, or forced redesigns of production components. Those unable to secure silver reduce output or temporarily shut lines entirely. Such disruptions propagate through supply chains, creating secondary shortages and delivery backlogs. Costs increase non-linearly because substitution options are technically limited or impossible. This reinforces urgency among remaining buyers, accelerating hoarding behavior across sectors. Hoarding is rational under uncertainty, despite appearing inefficient from traditional economic models. Once metal leaves circulation, it rarely returns quickly, even at higher prices. Producers prioritize internal inventories as insurance against future procurement failures. That behavior tightens markets further regardless of nominal production, increases reported publicly. Meanwhile, governments assess strategic exposure due to silver's role in its energy defense technology. Policy discussions emerge quietly without public announcements to avoid panic reactions. Strategic stockpile releases, if attempted, would offer only temporary relief at best. Such releases risk signaling vulnerability, encouraging further private accumulation by institutions. Therefore, authorities often choose observation rather than intervention during early shortage phases. This mirrors historical responses during rare earth and semiconductor supply crises previously. Recycling. Industry responds slowly, constrained by collection logistics, processing capacity, and environmental compliance. Higher prices incentivize recovery, but timelines extend beyond immediate market stress. Windows mining. Companies announce expansion plans, but capital markets demand sustained price confirmation. First, permitting delays, regulatory uncertainty, and community opposition slow new project development. Even brownfield expansions require equipment, labor, and financing unavailable instantly. As a result, projected supply increases remain theoretical rather than actionable, short-term. Financial markets begin repricing related equities, commodities, and derivatives exposures. Accordingly, silver miners outperform broader markets, reflecting leverage to rising realized prices. However, equity gains do not translate into immediate metal availability improvements. Investors misinterpret mining stock rallies as resolution signals incorrectly. Physical market tightness persists, regardless of financial asset performance trends. Banks reassess commodity risk models, adjusting assumptions around delivery probabilities. Clearinghouses raise margin requirements, further reducing speculative participation. This removes paper supply that previously suppressed prices artificially. Volatility initially spikes, then stabilizes at higher levels, reflecting new equilibrium. Premiums remain elevated, indicating persistent disconnect between futures and physical transactions. Retail markets experience rationing, with dealers limiting quantities and extending delivery timelines. Public awareness grows slowly, constrained by delayed mainstream coverage of technical shortages. When coverage expands, narratives lag. Reality already priced by institutional buyers earlier. Late entrants face unfavorable terms, reinforcing perception of unfair market access. This perception fuels distrust toward financial pricing mechanisms and official statements. Trust once broken is difficult to restore without visible surplus restoration. Historical precedent shows commodities under physical stress reset permanently higher. Examples include uranium, rare earths, and certain agricultural inputs during shortages. Silver now follows similar dynamics due to consumptive demand and limited elasticity. Energy transition policies unintentionally amplify demand without securing raw material pipelines. This mismatch between ambition and resource availability underpins structural commodity inflation. Manufacturers pass increased costs downstream, affecting consumer prices indirectly over time. Inflation metrics lag, commodity shocks creating delayed policy responses by central banks. Monetary tools prove ineffective against supply-driven price pressures. Historically, interest rate adjustments cannot conjure metals or accelerate mining timelines. Therefore, policymakers tolerate higher prices while monitoring economic transmission effects. Strategic industries receive priority access through informal coordination channels. Quietly, smaller economies face disproportionate impacts lacking bargaining. Power or stockpiles, global trade patterns adjust as exporting nations retain more output domestically. Export restrictions or informal discouragements exacerbate scarcity perceptions internationally. This encourages further stockpiling, reinforcing feedback loops within the market system. Feedback loops accelerate until demand, destruction or supply expansion, intervenes meaningfully. Demand destruction occurs only when prices force technological substitution or reduced consumption. Silver's irreplaceable properties delay that adjustment relative to other commodities. Supply expansion requires multi-year investment cycles incompatible with immediate relief. Therefore, the second phase persists longer than most market participants anticipate. Analysts relying on historical averages underestimate nonlinear effects under structural scarcity. Traditional valuation models fail when availability rather than cost determines outcomes. Market narratives shift from speculation toward risk management and continuity planning. This reframing changes how silver is discussed across boardrooms and ministries. Price becomes a secondary concern behind assured delivery and contractual certainty. Those securing supply early gain strategic advantage over competitors unable to adapt. This advantage compounds through market share consolidation during disruption periods. Thus, silver scarcity influences industrial structure, not merely commodity pricing charts. Understanding this helps explain why volatility does not imply imminent collapse. Stability at higher levels reflects functional repricing under new constraints. Observers expecting rapid reversals misunderstand the underlying drivers entirely. The market is no longer trading expectations but rationing reality. That reality defines the second phase of the silver repricing cycle. The final phase emerges when scarcity reshapes behavior rather than merely influencing prices. Markets stop debating valuation and focus entirely on long-term access strategies. At this stage, silver functions less like a traded asset, more like infrastructure. Industries redesign procurement around security, reliability, and geopolitical alignment considerations. Supply agreements extend years forward with fixed allocations rather than flexible volumes. Producers demand prepayment, equity stakes, or strategic partnerships to guarantee output. This shifts power from buyers toward miners, refiners, and sovereign stakeholders. Countries reassess domestic resources, recognizing vulnerability from import dependence, realities. National policies quietly prioritize internal availability over global market participation. Export quotas, licensing delays, and informal controls become increasingly common tools. These measures rarely appear as bans, but reduce effective supply internationally. Global pricing fragments as regional premiums diverge based on access conditions. A single reference price loses relevance across fragmented physical markets. Logistics security, insurance, and storage capacity become competitive advantages themselves. Entities controlling vaulting and transportation gain leverage, previously underestimated. Financial products referencing silver lose credibility as hedging instruments. End users seek physical contracts rather than derivative exposure entirely. This accelerates the decline of paper dominance in precious metals markets. Once paper volumes shrink, volatility decreases, but at permanently elevated levels. Stability returns only after consumption aligns with constrained production realities. That alignment occurs through efficiency, redesign, substitution attempts, and demand. Prioritization, however, substitution remains limited due to silver's unmatched conductivity and reliability. Technological innovation focuses on reducing usage per unit rather than elimination. These efficiency gains take years to deploy across industrial ecosystems. Meanwhile, baseline demand continues rising, driven by electrification and digital infrastructure. This ensures tightness persists even as growth moderates gradually. Price then reflects marginal availability rather than speculative marginal demand. Such pricing regimes resist collapse, absent significant oversupply events. Oversupply appears unlikely given mining timelines, capital discipline and regulatory environments. Investors misreading stability as peak risk, underestimating duration impacts a gain. The long-term effect manifests as higher cost floors across industries. Those costs feed into broader inflation measures with delayed recognition. Central banks respond cautiously, acknowledging supply-side origin constraints. Policy coordination shifts towards securing inputs rather than suppressing prices. This represents a structural change in commodity governance philosophy. Markets increasingly segment between strategic materials and discretionary commodities. Silver firmly enters the strategic category alongside energy and semiconductors. That categorization alters investment flows, regulatory treatment and national priorities. Public discourse lags this shift due to technical complexity and opacity. By the time consensus forms adjustments already embed within systems irreversibly, late recognition does not reverse early mover advantages secured quietly. Historical cycles show such repricing events define decades, not months. The silver market now reflects that historical patterns. Unmistakably, future corrections occur, but around higher baselines, not previous norms. Volatility becomes directional within constrained ranges rather than mean reverting. Participants adapt by focusing on resilience rather than timing cycles. This behavioral shift marks the maturity of the new market regime. Understanding this helps distinguish noise from structural signal accurately. Observers expecting dramatic collapses overlook fundamental consumption dynamics. Observers expecting infinite rises overlook eventual efficiency responses. The reality lies between governed by availability management over time. Those analyzing supply chains gain clearer insight than chart-focused traders. Physical flows, inventory data, and contract terms become primary indicators. Headline prices serve as lagging reflections of deeper adjustments. This perspective reframes how silver should be monitored moving forward. It is no longer merely an investment narrative, but an industrial necessity. That necessity anchors demand beyond sentiment-driven participation. The market therefore stabilizes through rationing rather than abundance. Such stabilization feels uncomfortable but represents functional equilibrium. As equilibrium sets, volatility decreases, though prices remain elevated. This is not a bubble phase, but a reset phase. Understanding resets prevents misallocation driven by outdated assumptions. For analysts, clarity requires abandoning pre-shortage frameworks entirely. Silver now trades under scarcity logic, not surplus economics. That logic prioritizes security, continuity, and strategic planning. The transformation appears subtle, yet profoundly consequential long-term. Those ignoring it risk misunderstanding future commodity dynamics broadly. This cycle offers lessons applicable beyond silver into other critical materials. Energy transition strategies must incorporate raw material realism. Henceforth, ignoring geology, timelines, and incentives creates repeated shocks globally. Silver serves as an early warning within that broader system. The repricing event highlights fragility within interconnected industrial ecosystems. Resilience requires diversification, stockpiling, and transparent allocation mechanisms. Markets gradually adapt, but friction remains unavoidable. Initially, this adaptation phase defines the coming years for silver markets. monitoring behavior rather than price offers better foresight during transitions. Those prepared early navigate volatility with fewer disruptions. Those reacting late absorb higher costs and operational strain. The final phase is not collapse but normalization at higher constraints. That normalization reshapes expectations permanently across industries and finance. This concludes the structural explanation behind silver's historic repricing event. For continued analysis, follow this channel and stay informed on real market mechanics.